All right, everyone. Thank you so much for coming to our presentation today. This is Corbin Granger, Senior Vice President of Towne Benefits, and today we are going to be talking about the Patient-Centered Outcome Research Institute fee, also known as the PCORI fee. We do record these webinars, and we also send out the slides, usually about a day or so after. So look for that. That goes to anyone who was registered or requests it. So if someone in your office wasn't able to attend but registered, they will receive a copy of the recording and the slides. We also ask, please, if you have any questions, please put them in the question box and we will go through them at the end. With that, I'm going to go ahead and get started. Okay. All right, so as you know, this information is subject to change mostly from the IRS. The Form 70 is an IRS tax document. Also, HHS is involved in the calculation of the fee, and of course, if the law changes. So I, of course, am not an attorney nor a CPA. So the information that I'm providing today is really designed to be illustrative and not legal or tax advice in any way. All right, so what is the PCORI fee? The PCORI fee is a fee that was designed under the Affordable Care Act to fund what's called actually the PCORI Institute in Washington, D.C. Now, this institute's goal is to develop and implement what's called clinical effectiveness research in the hopes of better patient outcomes in medical care. So one of the things I liken it to, even though I'm not a doctor, is if you're comparing treatments, you can look historically at different things over time. For instance, in the 80s, if you had like a knee replacement or knee surgery, they would often put your knee in a cast for 6 weeks. And people really sometimes never gain the full mobility of their quads and knees again. And so now they basically get you out of bed right away. So the idea of this research, it was formulated much like a lot of it under the Affordable Care Act, was let's set money aside. We're going to develop these clinical effectiveness programs and determine if we can calculate better outcomes in medical care. So this research foundation is really funded by this fee. The fee applies to plan years before October 1, 2029. So it was set to expire in 2019, but it was extended for another 10 years. The PCORI fees are due annually on Form 720. Form 720 is a quarterly excise tax return. So for anyone on the webinar who's filed the Form 720 before, and we're going to go through a Form 720 in this webinar, you will notice that on the first page, it starts to talk about fuel excise taxes. And it's a rather long form, but there's only one part. It's called Part 2. And they added the PCORI fee calculation to this existing tax return. Okay, so we're filing by August 1st, actually, because July 31st is a Sunday. So that's the due date for plan years that end in the prior calendar year. So any plan year that you had that ended in 2021 that's subject to the fee will file by August 1st. So that begs the question of what is actually the type of plans that are subject to the PCORI fee. So health insurance carriers or issuers pay the fee directly to the federal government, to the IRS, each year for their entire fully insured book of business. So that fee is actually calculated in your premium if you're a fully insured plan, and part of that goes to the federal government under the PCORI fee. Now, as an employer with a self-insured health plan, so only employers on the line who have either a self-insured health plan or what we call a health reimbursement arrangement. And that's the type of arrangement where, let's say you have, excuse me, you have a fully insured plan with Optima and the deductible is $2,000, and you tell your employees, we'll pay up to $1,000 through a health reimbursement arrangement to help you meet the deductible. So it's not a health savings account, it's a health reimbursement arrangement. The health reimbursement arrangement can be combined with your fully insured health plan or with your self-insured health plan. There are also what we call standalone health reimbursement arrangements, which is the qualified small employer health reimbursement arrangement. There's no health plan. I'm not going to go into detail in this because if you have one of those, you would know it. The other one is the individual coverage health reimbursement arrangement, which is called an ICHRA, which is a type of where you can reimburse individual coverage in very limited circumstances, and for that reason, it's really not popular. So I couldn't imagine anybody on the line would have that. So again, I like to say this more than once because it's confusing as to the due date, because you're doing it annually on Form 720, which is a quarterly return, but you're only filing for one quarter and the second quarter, and for plan years that end in the prior calendar year. So how much is the PCORI fee? The PCORI fee actually changes each year, but it's based upon the average number of covered lives. So that means the employee, the spouse, dependents, anyone on COBRA, you calculate the average number of covered lives, and I'll show you how you can calculate that in a moment, and you multiply it by the PCORI fee for that year. So the fee is actually adjusted each year for medical inflation by HHS. So it changes every year. You will see for plan years that end in 2021, if your plan year ends on or before October 1st, 2021, so that basically means September 30th, the calculation would be $2.66 per covered life. That's pre-written on the Form 720, so you don't need to remember that. If your plan year ends October 31st through December 31st, so that would mean a November or December renewal, then the calculation would be $2.79 per covered life. So how do we count the average number of covered lives? And there may be a bit of a delay with these slides. So the first is what we calculate for your self-insured health plan. So if you have a self-insured health plan, so a level funded health plan, a self-insured health plan, sometimes it's called an administrative services only health plan. There are 4 ways to calculate your average number of covered lives. The first one is the actual count method, and that method adds up everybody covered on each day during the plan year and divides that by the total number of days in the plan year. That's a little bit laborious. Am I saying that correctly? Somebody can correct me if I'm wrong, but it isn't one that's very popular. We find that the snapshot count method is a lot more popular. And what that does is you're taking a snapshot in time, right? So you're looking at the actual covered lives on at least one day per quarter and divide by the number of days used. So to make it really simple, let's say you chose the first day or the last day of the month for the first month in each quarter, then you would divide by 4. If you wanted to use multiple dates, then you would divide by the number of dates that you used, okay? The dates must be within 3 days of the date in the other quarter, so you can't choose, let's say you're using the first month each quarter, you can't use January 15th and then April 30th. So we usually say, let's say you're going to look at the first month in each quarter, you would look at January 1st or January 31st, the first or the last day of the month, and count the lives on that day. So you could choose to use the first month of each quarter, the second month of each quarter, the third month of each quarter, and just very simply use one day, and then you end up dividing by 4, and that's going to give you your average number of covered lives. You can use more days if you like. Another method is what's called the snapshot factor method, and it's really the same thing. It's the number of covered lives on a date is equal to the sum of the number of participants with self-only coverage plus the number of participants with coverage other than self-only on that date, on the date multiplied by 2.35. You can use the Form 5500 method. I put this in here because, yes, it says sponsors who offer only individual coverage take the number of participants reported at the beginning of the plan year. That's really not going to be the case for your group plans. You're going to have plan sponsors who offer other than individual coverage. So you'd have to look at the Form 5500, the number of participants reported at the beginning plus the number reported at the end. And you would have to, if you wanted to use this method, you'd have to make sure that the Form 5500 will be filed by July 31st. So if you're planning on an extension, you can't use this method. So the first 4 calculations are for using how to count for your self-insured health plan. And so most of you probably just have a self-insured health plan. There's another segment that may have a health reimbursement arrangement. So those are counted a little differently. If you have a health reimbursement arrangement that goes with your fully insured coverage, then you pay the fee for the average number of lives covered by the HRA. So really what you're doing is you're using the 1 life per participant rule. You count each employee enrolled in coverage and you exclude spouses and dependents. If the plan sponsor, if you have a self-insured plan and an HRA with the same plan year, which should be typical, then what you're going to do is use the calculation for the average number of covered lives that applies to the self-insured health plan. So really what I'm saying here is if you have a self-funded health plan with an HRA, you're going to calculate it based upon the self-funded health plan, and that's going to cover your HRA. Because if you had to calculate it for your self-insured health plan and then separately for the HRA, you'd be paying 2 fees. So this way, you're just simply paying 1 fee. If you have a standalone HRA, and that would only be a qualified small employer HRA or an individual coverage HRA where you don't have a health plan, then you must pay the fee based on the average number of covered lives covered by the HRA, counting only 1 life per participant. So let's go to completing Form 720. Form 720, it's actually an 8-page quarterly excise tax return, but an employer filing the PCORI fee only files for the second quarter of the year following the end of the plan year. So page 1 has taxpayer information. Page 2 is the PCORI fee section. Page 3, you calculate the final tax, and then you're going to have the payment voucher. So here on page 1, Form 720, when you list the quarter ending, remember you're paying it in the current year. So it's going to be the quarter ending June 30th of the current year, not of the prior year. Then you're going to list your street address, your employer identification number, your city, state, zip code. You're then going to go to part 2, line 133 on page 2. So under part 2, you can see patient-centered outcomes research fee. And under it, there are 2 sections. It says specified health insurance policies. That was where a fully insured carriers, where the carriers would report stuff. You would be on line 133 for a self-insured health plan. So if you have a plan year ending before October 1, 2021, you would take the average number of covered lives and multiply it, put it in column A, multiply it on line C, multiply it by 266, and then put it in the fee section, and then over to the tax section. If you have a plan year that ends on or after October 1st, 2021, now I know it says and before October 1, 2022, this is for 2021 plan year endings. So this would be if you had a plan year ending on or after October 1, 2021 and before and up to December 31st, 2021. And that's going to be $2.79. So you would take your average number of covered lives times 279, put it in the fee section, and then take it over to the tax. So the only difference here is when your plan year ends determines what the fee is going to be. Then you carry it over to part 3, and you're going to complete. So you carry over the total tax from part 3 on line 3. Then you're going to complete 5 to 9. Most companies wouldn't have to report anything from a Form 720X. That applies if you had to amend a previous Form 720. And again, that's a situation where you would want to talk with your tax specialist. But in most cases, you're just simply going to be completing it for that year. And on line 10, you would indicate what the balance due is. We again ask you to review it by your CPA or your tax specialist prior to submitting it, and have the authorized party or payer sign it. Now, to pay it, the IRS, of course, would love it if you can use the electronic payment system for the second quarter. So if you're set up for that, for these taxes, you can. If you need to mail it in to the IRS, there is a payment voucher at the very end of the form. You indicate that you're paying it for the second quarter, but the amount of your payment, mail your check or money order. It says, please do not staple anything to your payment, and mail it in to the IRS. Along with the presentation, you'll get the instructions, and it has the IRS place to mail it based upon your location. And so that really is a brief review of filing the Form 720. And we ask that you should always consult with your legal or tax specialist for information relating to how you're filing and the applicable PCORI fee filings. And we also recommend that your CPA or tax specialist always review your forms prior to submitting them. So it isn't really a difficult form to fill out. It's just a matter of calculating your average number of covered lives using one of the 4 methods and how you calculate lives with the method if you have an HRA. So with that, I'm going to go ahead and open it up to questions. I'm going to go ahead and close. Okay, so I don't see any questions. I'm hoping that means that everybody could hear okay and see the screen. And if you do have any questions, you can let me know. We really want to thank you for the privilege of having your time today, and have a wonderful afternoon. Thank you.